Preston with Score Cleveland, and I'm joined this evening with Chris Anna Lazar and Richard Brooks, and we're part of a team that put together this course, and so we're each going to be presenting parts of it, and so we will start out, first of all, talking just a bit about SCORE. And SCORE is a national nonprofit organization that's affiliated with the U.S. Small Business Administration. Started back in 1964, not long after President Kennedy challenged us to ask what we could do for our country. And a lot of people signed up to give business advice to small business owners and people that wanted to start businesses. And we've been going ever since. Our mission, vision, and values, as you can see, are very focused about entrepreneurs and people who want to start businesses, and it is very important. It's one of the things that no matter all the disagreements we have, something everybody can agree on is a small business deserves support. And we do our support through primarily mentoring, individual mentoring of people that are aspiring to be entrepreneurs. We also put on workshops like this one, and we have a lot of web-based resources, and I'll show you some of those just very briefly in a minute. SCORE has made an active effort to reach out to all groups in society and to a diverse variety of clients. And again, it goes back to our mission statement to provide everybody with support to start a business. And so we're trying not to overlook anybody. This is a web page of SCORE Cleveland, and it's set up very much like the national one. And we're just one of a large number of chapters throughout the country. What you might find interesting is that the in toolbar, there's a toolbar on the top across the top. That's national SCORE resources that you can access. And then once you put in your zip code, or if you go to a chapter site, you also have resources, local mentors, local workshops, resources. Our resources are aimed at northeast Ohio and community partnership. So it's really got a lot of content to it. Also, as you may be aware, SCORE Cleveland's a very dynamic organization that won the 2022 National Chapter of the Year competition. So we are working very hard to keep on getting better. Now we're ready to go on with the presentation, and I'll do some of the early slides. And so this is, we built this consciously for people who don't like accounting, people whose eyes glaze over when they look at this stuff, but they know they need to know something about it. And so we really, those of you that might have been in the first session probably saw, we focused on the basics and not the niceties of all the arcane rules of accounting, but just the basic concepts of finance and kind of how you can use finances just to do the financial things that need to be done, but also to use it to get intelligence to manage your business and make good decisions that are based on data. So we're going to continue that trend in this session. And as you can see from the agenda, we're going to be practicing this time, basically. So we're going to be looking at some very, very, very simplified financial statements. And we saw a little bit of that yet with some businesses in the last session. We're going to talk about how things might change in changing conditions, or when a business owner is looking to grow their business or expand it. Some of the ways that data can help you make decisions, and both adverse and good. And then we're going to open it up to all of you to give us your thoughts on how your business might be using financial data, and if you have any tips to share with the others, feel free. If you remember, those of you who were in the last session, one of our example companies was Puzzle Mania. This is a producer of a product rather than a service. And this is a cash flow statement. And if you remember from the last session, there are really three basic types of financial reports. There's profit and loss statement, the cash flow statement, and then the balance sheet. And we're just taking the first two of those in this series. Um, but the cash flow statement is basically a way to look at what your checkbook's going to look like into the future. You record the past and then you use that data to project the future. This is a grossly simplified cash flow statement. It's very simple. All it is the beginning balance, all the cash, all the revenue that came in during that month, all the expenses that got paid during that month, and then when you add the cash in and subtract the cash out, you end up with a balance. You carry that balance to the next month, and again, you add the cash in, subtract the cash out, got a new balance, and just keep on going. Very simplified. In reality, you would have some breakout into the source of the revenues that were coming in and some idea of what the expenses are that are going out. And those would be broken out into more categories. But it would be an eye test. We'll try to stick that on here. And again, we're not trying to teach accounting, but just to focus on basic concepts and how we can use them. So that's basically how this works. It's a very ultra simplified one. So if you look at the data and just look at those balances, any indication, and you can register in the chat box or in the question and answer box. Anybody see any indication whether this business is seasonal? Okay, I don't see anything yet. Oh, here we go. I think don't see it. Okay. Anyway, if you look at the balances, you will notice that it starts out 20, 30, 40, 50,000, and then suddenly it starts going down in the summer, goes down to a real low point here of $234, and then it gradually starts building up until it goes way high in December. So that sure looks like the holiday seasons. And so obviously, if you look at the lean months, you can see that it's really starts in July, it starts going down, and then it's August, and then September gets really low, kind of low in October, and then it starts back up again. So those are the lean months. And then any thoughts on how an owner might deal with seasonal fluctuation like that to make sure they got enough cash? You probably don't want to run your balance down to $234 very often. Yeah, let's look at the chat box. Okay, looks like the business generates more revenue in the fourth quarter. Get a line of credit. Okay, yeah, a line of credit is a way a lot of businesses do that. Another way would be to build up a financial reserve. And again, you want to get enough to get you through the tight spots, but not so much that your money is sitting there getting paltry interest and not really doing anything. So that's kind of an idea where even a very simplified view of a company's cash flow can still give you some sense of what's going on, and you can look for trends and you can look for ways to fix these things. The other major report then is the income statement or profit and loss statement. It could be known by either name. Now, this is a different view, and this, if you remember Chris's presentation last week, a little different from this, but it very much like it. And so revenue broken out by each of the product lines. In this case, is three different sizes of puzzles. And so that's all the money. And this time, unlike the cash flow, this is broken out more finely by source. So you got the total revenue. And then remember the fixed versus variable expenses. Well, here they are. The variable ones, the expenses that are associated with the product that vary up and down with the quantities of product itself, those things are broken out by each product line and then they're totaled up. And when you take all your revenues and subtract all your variable expenses, you get something called the gross margin. And I think you probably saw that in the definition sheet that was the last slide, last week's presentation. Okay, that's the gross margin. That's not your profit at all, but that at least tells you on a product basis how much money is there. Then you subtract from that your fixed expenses, those expenses like rent and utilities and things that don't change from month to month based on your volume of product, and you end up with profit. And of course, again, in a real profit and loss statement, the revenue would probably be broken out more finely. You'd have direct labor, direct material for each piece, your variable expense, excuse me, in the variable expenses, direct labor, direct materials, you'd have a listing of what those fixed expenses are, and then you would have your profit before taxes, and then after taxes, and any other things. There's usually several more lines on one. So a real profit and loss statement, again, is much more complicated. Also, this one shows it's an annual basis. In reality, most profit and loss statements are monthly or maybe quarterly at most. But again, it would be an eye test. Had a bunch of months across here. So with all these categories. So we did that. Also, you can see that we laid out the money by money and by dollars and also by percentage. So now, if you look at the questions over here, then as far as how it differs cash flow data, we've talked about this some. Anybody see anything else? Okay, yeah, I see some more comments on the cash flow. Yeah, as far as preparing for the lean months. Uh, okay, on the profit and loss, one thing you might notice is that both the revenue and the variable expenses are broken out by individual product line. Where a cash flow statement mostly looks like your checkbook, it's all the money coming in, coming out. It may not be broken out quite this way. So that's probably the chief difference. Also, the money in a cash flow is recorded when it hits your system. So when money comes in, you might have made the sale in one month, and money might come in a later month. You show it when that happens. Uh, Profit and loss statement. There are a couple of ways you can do it, but there it's a little again. I don't want to get at the niceties of accounting, but there are some differences there in how it's laid out and when the money actually hits. Did the company make a profit the first year? Well, that's kind of pretty easy because we put percentages here and it's 21%. So yeah, they did indeed. Okay, what product brought in the most revenue the first year? Again, that's pretty easy. That's right in the chart because here's your revenue, and you can see that of the three, it's that 1,000-piece puzzle that got the most revenue. The next question, we'll have to do a little bit of math. What product was most profitable? And to do that, and again, in a real one, you would probably have in this case, we just totaled up all the revenue and all the variable expenses and came up with gross margin. However, in a more detailed one, you would subtract the revenue, take the revenue, subtract the variable expenses, and calculate a gross margin for each of those product lines separately. And if you were to do the math, and what you would find is the gross margin for the 1,000-piece puzzle is the most shows it's the most profitable at some $64,650. So again, we oversimplified it, but in real life, you probably will be tracking your gross margin by product line. So that's kind of an introduction to both the profit and loss and the cash flow statement. Now let's move to a service provider. And those of you who were with us last week, remember Lulu's Beauty Shop? Again, the cash flow statement is very simplified. You take a beginning balance, add the cash in, subtract the cash out, got a new balance. Move it to the beginning, carry it over to the beginning of the next month, do the same thing. So again, it's laid out the same. And so if you look at it, do you see any significant seasonal variation? Um, Nope. Okay. Yeah. No seasonal variation. A steady increase. Yeah. This is Amazing. Whoops, sorry about that. Let me get feedback. Okay, sorry about that. Okay, so yeah, no seasonal variation. So this, especially when this amount's going up, she probably doesn't need a huge cash reserve, at least right now. Now, things are subject to change, and we'll see a little bit of that later. Again, the profit and loss statement is laid out the same way as Puzzle Mania. So we got three product lines here: shampoo, uh, color, hair coloring, and then other. And so again, you captured your revenue, you totaled it, you captured your variable expenses, total it, calculate your gross margin. In reality, you probably want to calculate a gross margin for each of those product lines. Then you subtract your fixed expenses, you got your profit. As far as what service brings in the most revenue, again, revenue is pretty easy to see here because it's explicitly laid out on the chart. And so, yeah, the revenue is coloring. It's the most profit, or it gets the most revenue. As far as the least costly provide, well, again, we have that um, because that's under the variable expenses, and the cheapest is shampooing. So you notice the percentages here, and any thoughts on why we're calculating percentages when you can see the numbers directly? Any thoughts on that? Okay, I do see a question here about salaries, whether they're in the are salaries in profit and loss. I'm not sure what that question means, but maybe we can talk about that in a bit. But okay, I don't see. Let's see. Okay, easy to compare. Okay. Um, yeah, the percentages make it easy to compare, especially over years when the numbers, absolute numbers, change due to inflation, market changes. The percentages are can tell you more about the proportions of your revenues and your expenses by product line. So in this case, it looks like it was just done just a peanut butter spread. It was just calculated. I think it was 10% per year increase. In reality, you're probably going to want to forecast with a little more finesse and try to actually sort out, try to project some trends and look at both risks and opportunities in the marketplace. For simplicity, we kept it this way. But in reality, if these are your actuals, you're probably going to be pushing some product lines more. You're going to do things to increase profit, which leads us to our third question. How would you increase profit in an operation like this? Any thoughts on that? Okay. Well, one possibility would be to raise the price of shampooing. It's a cheap service, but the revenues are also cheap, and maybe customers would still come in for a shampoo job. That's one possibility. And again, maybe they wouldn't. Then you have to talk to your customers to find out. Another possibility is to market the coloring, which is your most profitable product line. And so maybe if you do more of it, you're going to increase your profit. Another possibility, the third category here is other. Uh, there are probably a lot of services in there, manicures, pedicures, various kinds of services that could be broken out. And you might find in there some real gems in there that could be very profitable if you really marketed them aggressively. So the breaking out we talked a little bit about the cost and benefits of breaking out the data more finely. It takes some effort and sometimes some cost to break out categories into their components, but that can give you some good rewards. And this is such a big proportion of the work that it looks like this might be one that'd be worth breaking out a little more. So you never know what you might find. You might find some things in the other category that aren't worth providing, that are terribly unprofitable. Other things might be very profitable to bring to the fore and actually increase that and make a better profit. Okay. And again, the you can calculate your gross margin by product line, but you got to do a simple subtraction problem. So those are the kind of just a rundown of the statements. So now what we're going to do, Chris Anna's going to take over now. And so far we just kind of talked about, we've kind of laid out a structure for looking at the health of the business through the lens of cash flow and through profit and loss. Now we're going to look, the world changes. Businesses expand, they grow, they try different things to improve their profits. And we're going to talk about things that could go differently and what tools you can use to get data that helps you make better decisions. And also when something adverse happens, how you might cope with it. So Chris, you're on.
Great, thank you. So last week we looked at calculating profitability. We subtracted our fixed and variable expenses from our revenue, and we can see there were multiple different service and product industry businesses that we were able to calculate profitability. So there are other things that sometimes businesses have to consider opportunities. Do they want to offer a coupon or different advertising opportunities? So we're going to look at how do some of these things affect your bottom line and your profit margin? It's pretty surprising. So even something as simple and small as offering a 20% off coupon, we're going to look at some examples of what that does to your bottom line profit margin. This is a different example. Lulu's is a salon that we looked at last week. They were very profitable, I think in the 20 to 21% profit margin arena. They've been doing well for 6 years, and Lulu is considering opening a second location. So what does she need to consider to see if this is a good idea or not? If we just recap what we went over last week, her on the left-hand column, those are her fixed expenses, $11,420. Her variable expenses are 60%. And based on doing roughly 108 services a week, she's bringing in $55,728 a month. If she subtracts all of her expenses, she's profiting close to $11,000 a month at her salon. So maybe Lulu is thinking, well, everything is going well. We're profitable. We've got a good following. Maybe I can do this at another location and I can bring in another $10,000 a month from a second location. Then she'd be making over $20,000 a month. So one thing that we didn't look at is profitability with Lulu's time incorporated into the equation. So a lot of times owners work whatever hours they work. When the business needs them, the business is like a baby. When it's crying, you got to get up and take care of the baby. So Lulu works a lot of hours at her salon, and we had looked at her fixed and variable expenses both on, there was labor side of a manager. We also had the commissions that she was paying, but we didn't calculate with Lulu's time involved. So her revenue was $55,728. She had a 20% profit margin based on her fixed and variable expenses without her labor. Now, if we look at it, she's putting in about 55 hours a week, And she would have to pay someone in the arena of $35 an hour. This is not basic technician work. She's managing people, she's doing bookkeeping, she's doing work that she would need to pay roughly $35 an hour. So if we multiply 55 hours a week times 35 times 4.3 weeks in the year, we are going to be losing $8,278 in our second location's expenses that she didn't have in her own first salon. So how does that affect the bottom line? If we subtract her new total expenses for the month of 55,135 from her revenue of 55,728, her profit margin dropped from 20% down to 5% profit margin. So the real question is, for $2,593 a month, is this really something that Lulu will have to maybe build out a space, invest money in the build out, or take a loan for the build out? We didn't even incorporate any of those types of things. So she'll either have to use her own money or bank's money to build out another space. There's probably time it's going to take until her second location is profitable. So even if all things go as perfectly as can be, and she's as busy in her second location as her first location, she has to consider, is a 5% profit margin worth it for her to look into that? So for some of you who own your own businesses, you don't keep track of your hours, you don't pay yourself a flat amount, you just, whatever's left over in profits of the business is what you make. These are things to consider when you want another location, or maybe you want to step away, or this is something very seriously to consider if you're looking at selling your business and someone else would need to come in and, let's say it was going to be an absentee owner and they just wanted to buy the business. These are the types of things that need to be looked at.
Hey, Chris, I'm sorry to disturb you, but one of the attendees is saying they don't understand what we're talking about here.
So we started out looking at the profitability. Is there a little more, just, I don't understand in general?
All they've said here is, I don't understand.
Yeah. So we're starting out, if you look at the left column, you have expenses for her salon, which left a very healthy profit margin because Lulu worked her own salon. She did not account for her hours to run the business, to do all of the things that need to be done at the salon was not counted. That's just what she put in her pocket. So she profited about $10,000, almost $11,000 a month, but she worked very hard for that. She works roughly 55 hours a week to put that $10,871 in her pocket. So she's thinking, let me open a second salon. When we look at profitability, she can't just duplicate her existing salon and say, I'm going to open a second salon, because where's Lulu? You can't make two Lulus. You have to hire another person for the second salon to replace all of the work and energy and coordination and management that Lulu does at her first location. She can maybe do a little bit more, but she doesn't want to work more than 55 hours a week. So she really would have to hire another person to do what she does at her first location. She'd need to hire someone who did her role in the second location. When you subtract all of the expenses plus another Lulu's time, you're left with a very small profit margin compared to what she's making in the first store. I don't know. Let's see. If I look at the chat, Katrina did that. I don't know if you can give a thumbs up or if you had a more specific question or if that answered it. Can people take themselves off of mute, or that's all muted? Is everyone automatically muted? I don't know. Okay. Oh, it looks like we're trying to maybe take off some of the mute. So we have another comment. It seems like it's vital to always factor the owner's labor into profitability analysis. Is that right? So I would say there's many ways. I mean, there are guidelines in accounting, but I would say many owners don't work regular hours, so it's not as easy. There's always an estimation of how much do you put into it. So having owned my own business for 19 years, I can tell you, I don't know how I could possibly quantify exactly the time that I put into my business, because I would go to sleep and think about my business and be working on it. I'm like, getting ready, getting dressed in the morning, and I'm thinking about my business. So owner's time and all of that is a little bit hard to calculate. You certainly can account for what a manager would take and take that entrepreneurial part out of the equation that an owner has to do. Ideally, I think that it's benefits the owners if they can get to a point of stability and pay themselves a regular salary, and then take the rest of the money that they make in distributions along the way of, along the course of the year. That's an easier way to look at something. And if you did try and really quantify someone's responsibilities, you'd have to pay for whatever that work was. Again, I don't know if that answered the question adequately. Ready to move on? I think. Okay, so this is one of the things that I had brought up. So I think that we all see lots of coupons, lots of discounts all the time. And it seems like 20% off, relatively speaking, isn't even a big discount. I mean, if you're doing clothing shopping or certain things, it's not unusual to see 40, 50, 60, even at the end of season, 75% off. But even a small number like 20% can have a very significant effect on your bottom line profitability. So let's take a look at how that works out in an example. So we're back at Lulu's hair salon, and she is selling a variety of hair products. One of her products, let's say a bottle of shampoo, is $10 wholesale. That's what Lulu pays for the shampoo. And she sells it for $20 retail. So this is a very standard markup. Wholesale is half of retail. It's generally referred to as keystone markup. So many businesses, not all, but many retail businesses function like that. So her profit is she takes her $20 that she charges the customer, she deducts her $10 cost to buy the bottle herself, and she's left with a $10 gross profit per bottle. That's her gross profit margin. If she sells 100 bottles at $20 a bottle, she'll bring in $2,000 in sales. You have $100, I'm sorry, it was 100, that shouldn't have a dollar sign. 100 times $10 of profit is $1,000 of gross profit. So she sells 100 bottles, she brings in $2,000, and her profit is $1,000. She spent $1,000 for the shampoo, and she profited $1,000 after selling them at $20 a bottle. So if we divide the $1,000 that she made into the $2,000 that she brought in revenue, she's looking at a 50% gross profit margin. Now what happens? Let's say Lulu decides she wants to sell more shampoo. She wants to get people interested. Maybe she took on a new line. People are not familiar with this brand, and she wants to generate some enthusiasm and interest. So she says, I'm going to offer 20% off of this shampoo because it's a new line. People don't know about it. I want to encourage people to buy it. So all of this sudden, her new sale price, let's say it's the same, $10 wholesale, $20 retail. She's just taking off 20% to get people interested. So 20% of the full retail price is $4. So if we subtract $4 from the sale price of 20, she's going to be selling shampoo on sale for $16 a bottle. The same shampoo that she got $20, she's now getting $16. So she lost $4, but all of that came out of her profits. So now we're going to subtract $10 from the cost of the bottle, and we're going to subtract another $4 for the coupon that she gave people. So now her profit is $6 of gross profit per jar, where it used to be $10 of gross profit per jar. Same thing if she's selling 100 bottles at $16, now her total sales went down to $1,600. And if her profit is $6 a bottle, her now gross profit is $600, where it was $1,000. And if we divide 600, that's her profit, into 1,600, that's her total revenue for the shampoo, she's down to a 37.5% gross profit margin. So she went from $2,000 in sales to $1,600, $1,000 in profit down to $600 in profit, and a 50% gross profit margin to a 37.5 gross profit margin. Now, you may say that's fine, but how does she make that money back? What does she need to do, and how does this affect her business? So if she sold 100 bottles at $20, 2,000 in sales, 1,000 in profit, we're now comparing that to 100 bottles at $16 a bottle and $600 of profit. If we divide the $1,000 that she wants to make, that's what she made before she started offering a coupon, by the $6 that she's now making with the coupon, she's going to need to sell 167 bottles of shampoo just to make the same money that she made selling 100 bottles with no coupon. So this is the kind of thing you really have to think about: all the extra work, all the extra inventory, all the extra bottles of shampoo. You have to sell 67 more bottles to make the same money from that. What seems like a very small discount is a very big effect on your bottom line. So you now need to sell 167 bottles with a 20% off coupon to make the same money as 100 bottles with no coupon. One more thing, if you could go back, John, I'm sorry. I just want to say a couple more things to think about with this is she's going to have to invest. She invested $1,000 into those 100 bottles. She now has to invest $1,670 to sell those extra bottles. So she has to invest more money to increase her inventory. That's going to tie up more of her cash. She's going to be processing more transactions. So I'm guessing there's probably more credit card and transaction fees. And all the way that you look at this, it has a big impact. And I'm not saying don't ever offer a coupon, but I am saying be very strategic when and why you offer a coupon. So a couple things that I can think of that are good times to offer a coupon. Maybe, like I said, you have a new product line and you know that you need to do something to generate interest. That might be a time. It also might be a time that you want to take in new inventory, or things are getting kind of stale in the store and you want everything to be fresh and turn your inventory. There are from time to time situations where you just really want to clear things out and turn that inventory. There's also times that manufacturers might offer their own discounts. So let's say you sell Redken shampoo, or I don't know if that's dating, if that's even still a thing. It's what came to mind, but you sell a brand of shampoo, that brand might offer discounts 2 or 3 times a year. So if you can bring product into your salon discounted, then you can sell it discounted and not necessarily lose that profit margin. So there's a variety of situations where this is a good idea. And you just have to know how it's going to affect your bottom line so you can make appropriate decisions. Okay, we're now going to look at how does advertising look in terms of what is it going to do to your bottom line? Is it worth the money that you're going to spend? And what do you need to do sales volume wise to make that a reasonable step to take? So when you're talking about marketing and advertising, a very common term is called ROI. People want to know, what's the ROI? That stands for the return on your investment. So you want to see that this advertising dollars that you're spending is going to give you what? What is it going to give you? Is it worth it to spend this money? So let's look at our company, Puzzle Mania. They make puzzles and their revenue is roughly $30,000 a month. And we had calculated this all for those of you that joined us last week. Their profit margin is 21%. So they're looking at an ad that cost $2,200 and it brought in $14,000 in sales. And many of you might look at this at first glance and say, I'll do that all day long. I just made $14,000 and I only spent $2,200. But that's not really how it works, because you are looking at the sales. You're not looking, you have to see it from what profits did this generate in the sales. So to calculate this, the new sales, we're going to multiply it by 0.21. Because after they take out their expenses, they're at a 21% profit margin. So that leaves $2,940. That's the profit that they would normally make on $14,000 of sales. If we subtract the cost of the ad, which was $2,200, from the profits, $2,940, we're left with $740 of profits after the ad expense. We have $14,000 at $20 a puzzle. So that's going to mean they moved 700 puzzles to get that revenue, and $740 over $14,000 of sales left them with a 5% profit margin. So calculating the return on the investment, you take the gains, which is expressed in profit of $2,940. You subtract the investment cost of the ad, which was $2,200, and you divide by the investment cost, the same, $2,200. So we can calculate this. Their ROI, we subtract 22 from 2,940 and divide by 2,200, was 34%. That is their ROI on this particular opportunity. They made $740 and they spent $2,200 to get that. So again, you might be thinking when you saw the $14,000, that looks like a really good opportunity. You might be thinking, I'm not sure if I want to, do I want to sell off 700 puzzles at 5% profit margin? Just like we said, there are times that yes, you would want to do this. There are absolutely times in a business that you want to get rid of inventory, or maybe you absolutely need to bring in cash and you're willing to have a lower profit margin because you have debts that you have to pay off or whatever the situation is. There are absolutely times where this is worth it. It also, there's a lot of intangible benefits to advertising. So they say you could be a hunter or a farmer. And in terms of this marketing, the hunting is the kill. You bring home these new sales, but at the same time, you're also a farmer and you plant seeds that will come up later. People have brand recognition. You're putting this out in front of them. If they like the puzzle and you sell it at a low price, maybe they're going to then be a repeat customer and you can hope to get more sales out of it in the future. Those are very intangible and you just don't know, but you can look at your direct sales out of your advertising opportunity. We're going to look at the same example, but we just made a very small adjustment. Instead of $2,200, the ad actually cost $2,500. So again, $300, you might say, not a big deal. We're talking about thousands of dollars of sales. What does $300 matter? Well, if you know how to do these calculations, you can see yourself, this is what my profit is, and then ask, is it worth it? Is the time, energy, and effort doing all of this worth it? So how does this look when we do the calculation? We have the same $14,000 times 0.21. So our profit is the same as it's ever been. 21% is $2,940. But now we're going to subtract 2,500 from 2,940, and we see our profit after this ad expense is $440. So if we divide 440 by our sales of $14,000, we're looking at a 3% profit margin. That is really, really slim. You got to sell a lot of volume if you want to make any money at a 3% profit margin with anything. So the same thing, our ROI is calculated by our profit, the gains that we've made of $2,940, minus the investment cost divided by the investment cost. So we're down to a 18% return on our investment, and again, a $440 increase in profit. So when you are looking at ads or any of these types of things, having an idea of what you get out of it will tell you, should I do this again? Was this ad worth it? So marketing in general is good when you keep track of your numbers. How much sales? If you do all sorts of marketing and advertising, but you don't know what sales you're getting from what marketing and advertising, it's not helpful in terms of, should you do this again? Was it worth it? Should I tweak it? Should I change it? Another thing to think about when you look at these ad costs, a lot of magazines, newspapers, publications, all these things, they will have printed lists of prices for different ads for a full page, quarter page, this thing. Just know all of it is incredibly negotiable. The prices that they put out there are not necessarily the prices that you have to pay. So I'd say, especially if you have not advertised before, you can negotiate and say things like, I'm a small business and I want to see if this works, and I'd be very happy to continue to advertise with your company if I got the right amount of sales out of it, meaning it's worth the money and you made enough money to warrant wanting to do it again. So just know that all of those published prices are very negotiable. I think this is where Richard takes over. Additional strategies to improve profitability. Thank you.
Thank you, Chris. Yeah, we're going to talk about some additional strategies that will improve your profitability. And these aren't the only ones, but these are the most common. The first one is provide discounts or other perks to your best clients, not everybody. Okay. Not to the low volume customers who expect the same discounts as your largest customers, but don't buy much from you. Not customers who pay their bills in 60 or 90 days. They're using you as a credit card. Don't do that. Not customers who dispute many charges, and not customers who return a large portion of the products that they buy. Okay. So let me give you an example of this. My background is the hospitality industry. I worked in hotels and restaurants most of my professional career. And in the hotel business, we're always looking for people to put their heads in the beds. We have a sales department that would go out and encourage travel agents or corporations or groups to come and use our hotel. And we would, especially with corporations, we would entice them by saying, well, we normally charge $100 for this room. We'll charge you $90 if you're willing to guarantee us, a certain volume of business. And we would sign an agreement to that effect. And the hotel front office would track the sales of that customer. And there's a time limit on the sales. It's not like, you have to give us 100 rooms and there's no ending to it. We in order to get this discount, we're looking for 100 room nights per quarter, or 200 room nights per quarter, whatever it happens to be. And we track it. And if at the end of the quarter they don't fulfill that, we would then go back and say, okay, you didn't fulfill the handshake agreement that we had, or the signed agreement that we had. And so we're going to go back to regular pricing with you. It encourages them to give us the business. And so we want them to be high volume customers. And the way we're offering that is through a discount. And we do the calculation beforehand so that we know if they fulfill the minimum amount that we talked about in the agreement, we will actually make more money than if they just paid the regular rate, because we would not get the volume out of them. So we're always trying to encourage high volume. And I think what I'm trying to do is use that as an example for the question Jonathan Bird asked on trying to think about how discounts affect bottom line service-oriented businesses. Well, the hotel business is basically a service-oriented business. And so I'm giving you one example of that. Okay. Now, another thing that you can do, and you notice I'm talking about here at the bottom, is to give them a perk at no additional cost to encourage their business. No additional cost to you, but it encourages them to use your business. And first in line for available inventory. And it could be first in line for a new service. So, for example, if you're selling a line of clothes, for example, or let's say that you're selling hot water tanks for homes, and I say that because my father sold hot water tanks, you have it's a time of year when the product is in high demand, or you expect it to be in high demand. You can go to your best customers and say, we're going to give you first opportunity at these products. Okay. And I think sometimes trunk sales are another example of that. So, it doesn't cost you anymore to let those customers know that they will have the first opportunity, and it encourages them to frequent your business that more often. The same thing with services. If you're adding a new service onto your service-oriented business, you would go to your best customers and say, hey, we've heard from you in the past, or we've heard from our customers in the past, and we've had a request for this kind of a product. We're not going to or a service. We're not going to let everybody know about it up front. Eventually we will, but we want to let you know about it first. So go ahead and get your orders in so that we can provide you, because you're one of our best customers. So that's an example. And a good question here at the bottom is, do you have any customers who don't qualify for your best offers, and why? Every business probably has this, but it's a question that you should be asking yourself. Is there a way of encouraging customers without it costing me any more money? Or if I am going to do discounts, which potentially could cost me money, is there a way of conveying that to my customers in a way where I know I can make up the difference in revenue through higher volume? John, next. Okay, the next example is build a defendable fort. I worked for Nestle for a number of years, and Nestle's primary strategy when introducing a new product is build a defendable fort. And by that, they meant make sure that you've got a product or a service that is just really excellent and extremely competitive. A great example of that is, I think we're all familiar with Nestle Lean Cuisine. When they introduced Lean Cuisine, there was nobody else in the market at that time with this type of product. And so they did not introduce Lean Cuisine nationally initially. What they did is they went into certain test markets and they tested the product, and they made sure that it tasted good and people understood what it was for, and that they could sell the product. Was the packaging right? Was the portion size right? All these kinds of questions that they went through, okay? And then once they had tested the market and they had built that defendable fort, they knew what they were doing. They then went out and started selling the product nationally. So test your idea with your customers before you make a major investment in either a product or a service or staff or whatever it happens to be. And minimize your investment until you know you have a market for it, and do a competitive survey. It's interesting to note, using that Nestle example, that Lean Cuisine still has more than 50% to this day, and the product came out in the 1970s, that it has more than 50% of market share for that line of product, that nutrition-oriented, diet-oriented product, okay? And don't be afraid to think outside the box, but be cautious, okay? You want to do things that are competitive, and maybe thinking outside the box will make you competitive. It'll put your own special slant, your own special signature on the product or the service that you offer. And I'll give you a great example of that. When I was with Stouffer Hotels, which was a division of Nestle, people would, want coffee in their, to wake up to coffee in their rooms every morning. And most of our competitors were doing in-room coffee makers. And the coffee in those in those coffee makers is not good. We would deliver freshly brewed coffee to every guest that requested it, free of charge. It was just a service that we had. We would do shoe shining free of charge. We would deliver a morning paper free of charge. All they had to do is request it. And a lot of other hotels were doing something similar, but nobody was doing the fresh brewed coffee at their door. And it was a tremendous success for us. And it really built a lot of brand loyalty. It was better tasting coffee. It was delivered on time. People didn't have to know how to use the coffee maker. We thought outside the box and we made it work. Okay. So something that you might want to think of for yourself is, what does thinking outside the box mean to you? And that's a valid question that you might always want to look at when you're entering a market or when you want to expand your products or services. Next. Okay. How would you build a defendable fort? Do you have a defendable fort already? These are questions to ask yourself. Go ahead, John. Okay, reducing fixed costs. This is really important. Okay, and Chris provided an example of that at the end of her presentation when she said, some of these costs can be negotiated, especially in the area of advertising. You can renegotiate your lease. Not at all uncommon to work with a landlord where you would say, I'm more than willing to extend my lease by 2 more years. That guarantees you revenue. But in order to do that, I need some concessions on your part. And if you can lower the cost of the lease, the monthly cost of the lease, that is always something to think about. During COVID, the person who cuts my hair went to their landlord and said, my volume is down about 70%, which was true. And I need some help here. And the landlord, not wanting to lose that hair salon, cut their rent by 30%. And it lasted about 1.5 years. And then they came back once the worst of COVID was over. But there are different ways of doing that. That's one way. Another way is negotiating a longer lease if that works for you at a lower monthly cost. It guarantees the landlord revenue and over a longer period of time. And in today's commercial real estate market, that could be a real plus for a landlord. Be sure you are taking all the tax credits you're entitled to, especially if you have a home business. This is really important. A lot of people overlook their home costs. For example, if you have a 1,500 square foot home and you're using a 300 square foot bedroom as your office, well, that's 1/5 of the house. And working with your accountant, and I'm you got to work with your accountant on this. You could take 1/5 of your mortgage, or if you have an apartment, 1/5 of your the apartment that you're renting, that kind of thing. Those are legitimate business costs, and again, you have to work with your accountant so that you have the proper documentation in case of a company audit by the state or the federal government. But it really is worthwhile. The same thing with mileage on your car. Track all the business miles. There are apps on your phones today that you can just start up the app and it'll track the mileage for you automatically for every business trip that you make in your personal car, your cell phone, your utilities. All of that can be tracked and used as tax credits if you do it properly and you have the proper documentation. Consider lower cost suppliers. be careful on this. Lower cost suppliers are often a really good idea, but they may end up actually being more costly to you in the long run if the quality of the product or the service that you're getting is not what you need to be successful. A good example of that would be in the Puzzle Mania example of Puzzle Mania. Went to a cheaper paper cardboard for their puzzles. Maybe the puzzles don't last as long, or they get a reputation for the ink didn't hold on the paper real well, and the puzzles aren't as good as they used to be. So you have to be careful with that. But don't be afraid to competitively shop. Restaurants do this all the time. They have 2, 3, 4 major suppliers of the same product. They will contact them 2 or 3 times a week and say, what's your price for this? And they'll get competitive pricing, and they'll pick the supplier that has the best price at that time, knowing that the product is going to be, the quality of the product is going to be what they want, because they've already done that part of the competitive survey with their vendors. Finally, consider bundling. You see this all the time on television, bundle your home and auto insurance. Well, there are ways of bundling what you're buying from your suppliers. You can bundle 2, 3, 4 of the raw materials that you need from one supplier. And if you do that, it will lower the overall cost to you. So look for opportunities to bundle and save money in that respect. Another good example of that would be if you have home internet and you have a cell phone, and if you can do that from a major supplier where the internet and the cell phone are being purchased from the same supplier, they often provide you with discounts to encourage you to bundle. And so that's a good example. What fixed costs are negotiable when they are renewed? We talked a little bit about that. And can you renegotiate fixed costs before they are renewed? And the answer quite often is yes. But what you need to do is develop the relationship with the supplier and see what you can do there. Quite often, suppliers have ways of lowering your cost, but you have to ask about it first. And how would you verify comparable value when researching lower cost suppliers? Get samples and use those samples in your business process to see if they will really hold up. Don't be afraid to test. I can tell you that when I worked for Hyatt Hotels, we were constantly testing products that Hyatt was interested in bringing out to the public. Do we use a 350 thread count sheet, or do we use a 320 thread count sheet? And the 320 thread count sheet could be considerably lower, but we tested it anyway because we wanted to make sure that when we washed it, it would hold up. We always compared the 350 to the 320. We set up test rooms, didn't tell our guests about it. And then when they came to check out, we would say, how was the bed linen? Were you comfortable during your stay? So we would get it from several different points of view, and then we made a decision. Is it better to pay a little bit more and have a product that the guests like and holds up in a commercial environment, or is it better to pay a little bit less and get hopefully the same quality of experience? And I think I'm passing it along here, right?
Yes, indeed. Thanks, Richard. So far, Chris and Richard have talked about changes in the business world and how you make good decisions in the context of growth and reaching out and doing better. But sometimes bad things happen. So I want to just throw a couple of scenarios in there that just to think about using data to make good decisions when things go bad. So in this case, going back to Lulu's beauty shop, say she had a flood and their insurance didn't cover it. So we're gonna, for purposes of this exercise, we're gonna assume that the repairs to the shop cost $100,000, and she has a line of credit to cover it, but the interest rate is 7.25%. Well, how's that going to affect her cash flow? So looking at this cash flow chart, same one we saw at the beginning. However, you notice that back in March, the flood happened, and suddenly there's a big bump up of cash in. Well, that's the advance, that's the draw she took from a line of credit, and there's an extra $100,000 in cash out. That's the cost to actually do the repair. Now, in real life, it's not going to come out that evenly. It's going to be some different amounts. But again, we're being very simple here because we're focusing on the concept rather than the accounting niceties. But the idea is that suddenly both of these come up, and because the line of credit covered everything, the cash flow just keeps on going up. The balance just keep on going. She's got a powerful business. We've seen that. She's got a tremendous profit margin, as we saw largely because Lulu is donating her time. It's not showing up in the expenses. So it's looking good. However, in the subsequent months, it starts showing up and it starts dragging on profit. So she starts making payments on that, roughly $600 a month. I think it's 604 I calculated. Plus, she's going to want to pay that line of credit back so she has it the next time she needs some money. So let's say she's also throwing another 2,000 in each month, and that'll pay it off in about 4 years. So she's paying some $2,400 a month, and that's going to make that cash out a little more. It's going to drag it down. In this case, she is so spectacularly profitable. It doesn't, and I probably could have constructed the exercise so that something brought it down, but it would have taken a big catastrophe to do that. As powerful as she was in her profits. But it's an idea, and it doesn't always work out this way. Sometimes these kinds of disasters can sink a company because they can't make payroll or can't buy supplies. They can't provide their services and they go out of business. So in this case, Lulu's so powerful that she's able to overcome it. But think about if something happens, how are you going to handle emergencies like this, big disasters? And even if you got the line of credit or you got a reserve, you got to pay the reserve back. You got to pay the line of credit back. You got to pay interest. So think about that when you're thinking about your contingency plan. We've seen a lot of talk in recent last couple of years about supply chain disruptions. And so let's assume that Fred, the owner of Puzzle Mania, has, because of supply chain issues, the Suez Canal or whatever, trouble getting fiberboard deliveries on time. And he's got to carry additional inventory that requires additional facilities. And that's not an uncommon problem. So there are several things that might happen. First of all, something's going to increase, and if you have any thoughts, go ahead and put it in the chat box. And Chris or Richard, if you see something to respond to this, if you could, there's going to be too many in there. I can't go through them all while I'm talking, but if you see anything, by all means, let us know. But yeah, think about the categories and about what kinds of things might Fred do to deal with those additional facilities, and with the problem overall. So again, this is an example of something bad happening, and the business owner has to think about how they're going to recover from this problem, get back into profitability, and so think about the options Fred has too. So While we're waiting, just a few things that could come up. Um, he might decide to build or lease some more space. Uh, but in addition to the cost of the building or the leasing, there are factors like heating and lighting of that space to store that fiberboard, shelving and furnishing. So those are some of the additional costs beget costs sometimes. So you got to think about that. Options. Fred could find another more dependable supplier. He might be able to look around and find some cheaper storage options or some combination of the above two things. Any chat about these questions? Chris or Rich?
Yeah, Jonathan said that you might need to rent a bigger space for inventory.
Right. And maybe you can find something on the rental market that has the kind of protection you need without maybe all the expense of your own place. So it depends on where you are and how much space you have to expand. But yeah, rental might be, especially if it's a temporary supply chain issue. Okay. Another thing that could happen, we talked in both the last session and this one about the importance of data collection and analysis, not just to do accounting and do taxes and all the things you got to do, but also because it helps you make good business decisions. So in the case of Puzzlemania, Fred's been relying on an accountant of many years to keep the books and everything. Trouble is, she used her own system and nobody else understood it. And then one day she resigned suddenly and moved out of town. So what can Fred do? Likewise, in the case of Blue's Beauty Shop, he used an automated software product to manage her finances. But then the software company went out of business and there was no source for customer support. And the system's starting to get wonky. So how is she going to regain some accounting capacity? And really the two questions this all engenders, and how would Fred and Lulu respond uh, to get themselves some kind of accounting capability because it kind of looks like they got to start from scratch. And also, how might this apply to your business, and how might these kinds of situations have been prevented? So again, any chat activity, feel free to put your comments on, and Chris or Richard can relay them. And but think about that because it's nice to have a system. We've been talking about software and professionals and everything, but those things aren't entirely dependable, and you do need to be thinking about a plan B and how to prevent things from going south like this. So you're basically driving your. We talked about managerial accounting in the first session, where you're trying to predict the future. It's like driving you're driving your car in the dark without headlights. So it's kind of important to gain this capability. So, whether it's anything in the chat box, Chris?
Wait, something. Nope.
Okay.
We just got a note that there's going to be copies coming out of all of this. So if anyone wants clarification on any of the slides, now's a good time. We can pop back and go over anything that anyone might have a question about.
Yeah, we do.
So Jonathan says, in case number 1, could a business owner request that their account use industry standard systems? So John, I believe you spoke about this a little bit last week. You want to reiterate?
Yeah, in the case of a professional, if you hire an internal accountant, you probably and we talked about this in the first session, how it's important to pair up with your accountant when you're setting up your system and you're setting up your chart of accounts and all that, and make sure that as the accountant records past uh, transactions and helps you to forecast future ones, make sure you're using the same system. This can happen if you just throw the job of accounting over the fence to your accountant, then you go on and do the day-to-day things, and they're off in isolation. If they're using a system no one understands. Had Fred been talking to the accountant, he'd have known because they'd been talking all the time about how to make transactions more accurate, how to make forecasts more accurate. So yeah, talk to your accountant. Software is a little tricky if the company goes out of business, but at least if you understand how their system is set up, you might be able to find a replacement system that's built in about the same way. Might be a way kind of reconstitute it. But if you just accept what the system tells you, you don't know what's under it. You're never going to know the algorithms they're using and everything. But if you have an idea of the structure of how they treat costs and revenues, then you got a better chance, at least, of finding a substitute system that, yeah, you got to fat finger your data maybe into the new system. But yeah, those are things you can do to try to reconstitute. But yeah, prevention is far better. And if you can stay in touch with whoever's doing your accounting, or if you're using software, at least stay in touch with the methodology and know enough about it that you can go find substitute capability. Yeah, I think those are the keys. So just briefly, kind of like to open the doors to two things. First, let's just open it up to any thoughts about any experience you have that is similar to what we've been talking about this evening. And if you want to, feel free to again, I don't know if we can open microphones or not, but at least use the chat box and let us know if you have any thoughts, anything you'd like to share with your compatriots here. Any instances where you've used financial data to make decisions under changing circumstances, either for good or for ill. Again, feel free to jump in because we can learn from one another. We've built these scenarios, very simply, but you guys are the ones that are in business in today's marketplace right now. You may see some things that you never thought of.
I did allow everybody to open their mic if they want to.
Okay, great, Anita. Thank you. That will simplify the communication. So,
Yeah.
So just any war stories anybody has about something similar maybe you've seen.
Hey, I'd like to step in for just a second. Jonathan asked a really good question. In case number one, could a business owner request that their accountant use industry standard systems? And this is an important discussion point. Every industry has a uniform system of accounts, and it's really important that your business use that uniform system of accounts. They're all public domain information. You don't have to pay for them. Usually they come out from your business's trade association, and just about every business out there has a trade association on a local, on a state, and a national level. So it's really important that you do that for a lot of reasons. First of all, those chart of accounts are structured to benefit your business. They don't include things that really are not necessary for your business, and they do include the things that are important to your business, and they are structured for your business. So it's really important. In addition to that, if you ever want to get in to compare your operating numbers, especially the percentages and the operating statistics, with other companies of your size doing the same kind of business, the chart of accounts is the only legitimate way to do that. And there are ways of doing that, by the way. There's an organization called the Risk Management Association, and they actually put together those types of statistics. If you go for a loan, the lender usually uses Risk Management Association statistics to see how you're forecasting your numbers against industry averages. And you can, by the way, also have access to Risk Management Association free through a lot of business libraries in our community. If you were to do it on your own, you'd probably pay close to $1,000. But most business libraries in the area have access to Risk Management Association, and the business librarians will help you with that. So it's really important that you use industry standard chart of accounts for your business.
Okay, thanks, Richard. Yeah, that's we talked a little bit about charts of accounts and about how finally you break them out. But yeah, those are in existence, and yeah, using that standardized that standardized methodology, all the buckets for all your revenues and expenses, plus the standard accounting methods. Yeah. Okay. Any, and I just looked briefly through
There
the
is a
chat.
question in the Q&A. Are salaries profit or loss? I think you covered that very well last week. I guess I'm going to suggest that I just send the client a link to last week's presentation because I think it covers that very well. And it's kind of difficult to go through the whole thing at this time.
Yeah, we talked about fixed and variable costs. People who are working on your product or service directly, their labor is helping to provide that. Usually they're making they call it usually wages, not necessarily, but they're usually making wages. So that's a variable cost. People who are running the business, like Lulu running a beauty shop, is getting a salary. So a salary is usually a fixed cost. But obviously in the real world, especially in a small business, I'm sure that line gets blurred a little bit as far as whether it's fixed or variable. But they are certainly costs that factor into your profit and loss. Okay, any other questions? I see there's a question from Cyrus, a business MOAT, and I'm not familiar with that terminology. Chris or Richard, are you?
I am not.
Okay. Cyrus, do you want to?
Maybe he could unmute himself and tell you what he means.
Maybe the mode is related to a defensible fort.
Sounds like it.
Mode around it.
No, apparently not forthcoming.
Correct. Okay. All right. Okay. So it is. Okay.
Okay.
One other point we would like to make before we leave you is wherever you are in the journey toward building or growing a business, feel free to reach out to SCORE and get a mentor who can work with you and work these questions one-on-one in your situation, in your environment. Because the answer often financial questions are it depends. So one way to do it is to establish a relationship with a SCORE mentor that you feel comfortable working with. And when you come up with practical questions about finance and any other aspect of your business, you got somebody you can talk to. So that's our pitch for getting a mentor. Any other questions?
It does not appear so.
Okay,
So
well, thank you all for your
for
kind attention.
yeah.